Good afternoon and welcome to African Economy, a 30-minute business program dedicated to in-depth analysis of economic forces shaping Nigeria and the wider African continent. On this program, we examine key economic development, unpack critical policy decisions, and track emerging market trends that influence growth, investment, trade, and livelihoods across Africa. Here's what we have put together for you. Uganda holds interest rate at 9.75% as inflation stays below target. South farm export hits $15.1 billion record. Congo to enforce local ownership rules for copper and cobalt miners. We also look at the top 10 African countries with the most access to foreign exchange. You're welcome to the program. My name is Wangfonabasi Walter and I am delighted to be your host as always on African Economy. Let's begin with the currency market, particularly the performance of the US dollar against other African currencies. Across the continent, movement in the dollar continue to shape inflation, import costs and external debt servicing, especially for economies heavily dependent on foreign exchange inflows. From West Africa to East Africa, central banks remain cautious as currency stability increasingly determines investor confidence and fiscal sustainability. The US dollars against the Nigerian naira exchange rate fell to 1,353 naira 17 kobo, down to 0.76%. The US dollars against the South African rand is at 15 rand per US dollar, up to 0.31%. The US dollars against the Zambian kwacha is at 19 kwacha per US dollar, up to 0.74%. The US dollars against the Egyptian pound is at 46 pound per US dollar, down to 0.05%. And the US dollars against the Algerian dinar is at 129 dinar per US dollar. The US dollars against the Angolan kwanza is at 921 kwanza per US dollar, up to 0.46%. From currency pressures, we now turn to foreign investment and infrastructure development in North Africa, where Egypt has unveiled plans for a $1 billion mixed-use development on the Red Sea coast, showing its push to expand tourism capacity and attract more foreign investment into the sector. The projects, known as the Monte Gelala Towers and Marina, will include a marina, hotels, residential unit and leisure facilities. Construction is expected to begin in the second half of the year and span roughly 7 years, according to Ahmed Shalabi, Managing Director of Tawi Misa, the project's lead developer. The developments will comprise 10 towers and is being executed in partnership with Egypt's Ministry of Housing and other state entities, including the Armed Forces Engineering Authority. According to reports, the total cost is estimated at around 50 billion Egyptian pound, equivalent to about $1.7 billion. Staying in North Africa but shifting from tourism to security-driven economics, Turkey has signed a $350 million defense agreement with Egypt's Africa's top-ranked military and the world's 19th strongest, highlighting Cairo's ambitions and Ankara's deepening strategic push into African security market. The agreement was reached between Turkish state-owned armed manufacturer, Mechanical and Chemical Industry Corporation MKE and Egypt's Ministry of Defense during President Recep Tayyip Erdogan's official visit to Cairo, where he held talks with the President Abdel Fattah el-Sisi. According to report, the deal covers ammunition export and the establishment of local production facilities in Egypt, positioning the North African nation as a potential regional manufacturing hub for military hardware. In a statement, Turkish Defense Ministry said MKE would export the Tolga short-range air defense system to Egypt in a transaction valued at approximately $130 million, adding that the system is designed to detect, track and neutralize aerial threat, including drones, low-flying aircraft and emerging missile technologies that have become increasingly prominent in modern conflict zones. Beyond investment and defense, the real pressure for many Africans remains the cost of living. In 2026, cost of living index shows that daily expenses across Africa are shaped as much by income levels and import dependence as by headline prices. While the platform provides data for only 27 African countries this year, the ranking still highlights clear structural patterns across the continent. Let's take a look at Africa's 10 most expensive countries to live in, ranked strictly by Numbio's cost of living index. Top on the list is Seychelles, and the cost of living is 64.5%. Seychelles ranks as Africa's most expensive to live in. Its small size and heavy reliance on imported goods keep while restaurants' prices stand at 66.2. Although tourism drives economic activity, local purchasing power is modest at 34.3, making daily expenses expensive for residents. Second is Democratic Republic of Congo with 50.2. Despite its vast mineral resources, the Democratic Republic of Congo ranks second. Limited infrastructure and high import dependence in major cities push prices upward. Restaurants' costs reach 66.1%, I beg your pardon, while rent stands at 32.8, with purchasing power at just 26.3. The gap between incomes and living costs remains wide. Senegal's position reflects rising urban costs, particularly in Dakar, as they take the third in ranking with 48.5. Groceries are priced at 45.0, while restaurant costs reach 42.9. Although rent remains relatively moderate at 19.3, weak purchasing power at 22.2 means households continue to feel pressure from higher prices. Fourth is Cape Verde with 46.3. Cape Verde's island geography significantly raises the cost of living. Imported goods push the groceries index to 57.2. Despite low rents at 8.8, tourism supports the economy, but limited purchasing power of 21.3 constrains affordability for residents. Fifth is Ivory Coast with 44.8. Ivory Coast, one of West Africa's largest economies and the world's leading cocoa producers, continues to expand. However, rising consumer prices persist. Restaurant costs stand at 39.1, rent at 21.8, and purchasing power is low at 12.7, increasing financial pressure on households. Sixth is Angola with 42.3. It records an exceptionally high purchasing power index of 200.8, the strongest among the top 10. This reflects higher income levels for certain segments of the population, particularly in oil-related sectors, allowing residents to afford more relative to prices. Seventh on the list is Ethiopia with 41.8. Ethiopia's ranking reflects persistent inflationary pressures in a fast-growing economy. Groceries are priced at 44.5, while restaurant costs remain relatively low at 22.9. However, purchasing power stands at 12.5, making everyday expenses burdensome for many households. Going down, Cameroon with 40.7. Cameroon's mixed economy spanning agriculture, oil and manufacturing places its 8th. Groceries cost 37.8, while restaurant prices reach 45.5. Purchasing power is just 10.5, one of the lowest in the top 10, limiting affordability for most residents. Ninth is Mauritius with 38.3. Mauritius presents a more balanced profile, while living costs are moderate. Purchasing power is relatively strong at 55.1. Rent is low at 10.9, helping to ease household expenses. Its diversified economy driven by tourism and financial services, support income stability. 10th as the last is South Africa with 37.1. Now South Africa ranks as the least expensive country within the top 10. As Africa's most industrialized economy, it combines moderate living costs with strong purchasing power of 109.2, second only to Angola. This balance makes it one of the more affordable large economies on the continent. The data underscores a major concern, that is, high prices alone do not define affordability. Instead, purchasing power, currency strength, and domestic production capacity determine how households cope across regions. As African countries stare down the barrel of potentially tougher global financial conditions in 2026, access to foreign exchange FX, especially considering the debacle of the gold markets, present a very interesting challenge. At its core, strong FX access is required for portfolio investing, foreign borrowing, and cross-border trading. Transparent, rule-based, and integrated foreign exchange regimes reduce uncertainty, lower transaction costs, and encourage participation from both domestic and foreign investors. Where this circumstance exists, capital flows more frequently and market price risk more precisely. However, access to foreign exchange remains uneven over much of the continent. With that said, here are the African countries with the most access to foreign exchange rate. Let's take a look at the countries with the most access to foreign exchange rate. Top on the list is South Africa with 86 foreign exchange index. Second is Madagascar with 77. Third is Mauritius. 4 is Nigeria with 73 foreign exchange index. 5 is Uganda with 70. 6 is Egypt with 67. 7th is Kenya. 8 is Cabo Verde. And 9th is Botswana, among others. From FX flows, we move now to resource production in southern Africa. Angola's state-owned diamond miner Endiama plans to increase production to 17 million carat by 2027 after hitting a record high in 2024. According to a government publication circulated at the 2025 Africa Mining Indaba in Cape Town, Endiama produced 14 million carat of raw diamonds in 2024, the highest output in its history. The milestone lifted Angola to the position of the world's third largest producer by volume, behind only Russia and Botswana. An Endiama spokesperson said the company aims to further increase output, targeting 17 million carat over the next 3 years, up from 14 million. The strategy reflects Angola's broader push to maximize the value of its mineral wealth and attract long-term investment into the sector. Still on Angola, but now focusing on ownership and strategic control, Angola is seeking to acquire a 20% and 30% stake in De Beers, the diamond unit being put up for sale by Anglo American as part of a proposal being discussed with other African diamond-producing nations. De Beers, one of the world's largest diamond companies, operates across Botswana, Namibia, Angola, South Africa, and Canada. Anglo American has moved to prices and growing competition from synthetic stones. According to Angola's National Director of Mineral Resources, Paulo Tangana, they had submitted a bid for a majority stake in De Beers in October 2025, but has since shifted its position. Meanwhile, Angola's earlier majority bid raised the prospect of a bidding war with Botswana, which currently owns 15% of De Beers and has said it is seeking to increase its stake to a controlling level. From Southern Africa, we turn now to Central Africa, where policy shifts are reshaping mining ownership. The DRC, that is the Democratic Republic of Congo, will begin enforcing a long-dormant rule requiring mining companies to allocate part of their share capital to local employees. Mines Minister Louis Watem said firms must show that at least 5% of their share capital is held by Congolese employers. Companies have until July 31st, 2026 to provide proof of compliance, according to the letter which the ministry posted on X. The move could reshape ownership structures at some of the world's largest copper and cobalt producers and affect a wide range of industry mining projects in Congo, which supplies about 70% of the world's cobalt and is the second largest producer of copper. We will take a short break from here. When we return, we will examine more economic developments shaping Africa's future. Welcome back. This has been African Economy, bringing you inside the matter in Africa's evolving financial landscape. And now to the rest of other concerns in African economy. Mali will set up a state-owned company to manage its stakes in mining firms. The Council of Ministers said in a statement that other resource-high West African countries, including Niger and Guinea, already shipments to the United States fell sharply in second half of the year. The figure represented 10% year-on-year increase and marks the 7th consecutive annual rise in agricultural export, underscoring the sector's growing resilience amid shifting global trade dynamics. The strong overall performance came despite mounting trade pressures from the U.S. when new tariffs on selected agricultural goods significantly dented South African shipment. Wendell Shilobo, chief economist at the Agricultural Business Chamber of South Africa, noted that exports to the U.S. declined by 11% in the third quarter of 2025 and plunged by 39% the final quarter. While export to the U.S. weakened, South Africa increasingly leaned on other regions. To sustain growth. The rest of Africa emerged as the country's largest agricultural exports destination, accounting for 53% of shipment in the fourth quarter. Asia and the Middle East accounted for 17% combined, while the European Union accounted for 16%. By contrast, the Americans, including the U.S., accounted for just 4% of South Africa's agricultural export during the period, underscoring a notable shift in trade patterns. Let's turn our attention now to energy investment and of the planned acquisition of Total Energies and Brazil's Petrobras of stakes in an offshore exploration license, raising questions over whether the transaction will proceed. In a statement issued, the Ministry of Industries, Mines and Energy said the government had not been informed of the deal as required by law and was only alerted to the planned announcement minutes before it was released. Brazil state-run oil company Petrobras said it had acquired a 42.5% stake in an offshore oil exploration block in Namibia as it seeks to open new exploration frontiers in Africa to replenish reserves. On their part, Petrobras said the acquisition was made in partnership with Total Energies, which also took its 42.5% stake and will operate Namibia's PAL 104 offshore license, acquired from 8 offshore investment holdings Amaravilla Oil and Gas, although the company did not disclose the value of the transaction in a securities filing. From energy, we move to the capital controls and markets regulation in West Africa, where Ghana, a major producer of gold and cocoa, is emerging from its worst economic crisis in decades and is expected to complete a 3-year support program with the International Monetary Fund in August. In a circular, the Securities and Exchange Commission (SEC) said that with immediate effect, local fund managers will be permitted to invest no more than 20% of assets under management in foreign securities. Funds that were previously allowed to invest all of their assets offshore will now be capped at 70%. The regulator added that investment in foreign securities will only be permitted in jurisdictions that have information sharing arrangements with Ghana's SEC. The move aligns with broader efforts by President John Dramani Mahama to retain capital within the domestic and regional economy. Finally, an African economy. We close in East Africa with monetary policy development. Now, the Bank of Uganda, BOU, has maintained its central bank rate at 9.75%, where it's remained since October 2024. Governor Michael Atingi Ego said the policy stance remains appropriate to support economic activity while keeping inflation anchored around the bank's 5% medium-term target. Inflation remains well below that level. Headline inflation edged up to 3.2% in January 2026 from 3.1% in December, mainly due to higher prices in some services, including air transport. Over the past year, headline inflation averaged 3.5%, while core inflation averaged at 3.8%, the central bank said. According to the BOU, the low inflation environment reflects tight monetary policy, coordination with fiscal authority, a relatively stable exchange rate, and easing global inflation. Food prices moderated sharply in January due to favorable weather, partly offsetting modest increases in energy and fuel cost. The central bank expects inflation to remain slightly below target in 2026, within a 3.8% to 4.3% range, before stabilizing around 5% over the medium term. However, it warned that risks remain elevated, including stronger domestic demand driven by government spending, exchange rate pressures, geopolitical tensions, and weather-related shocks to food supply. And that brings us to the end of today's edition of African Economy. Thank you so much for watching. Be sure to follow us across all our social media channels at Spectrum TV. Remember, African Economy airs live every Tuesday and Thursday at 2:30 p.m. Until next time, keep thinking growth, keep thinking progress, because this is where Africa's economy speaks. I am Wafana Basi. Goodbye, Africa.